Welcome to this explainer. Look, if you're building in hard tech, climate, biotech, or defense, you already know your path is just fundamentally different from the rest of the startup world. Today, we're mapping out that grueling but absolutely fascinating 5 to 10-year journey. From that very first scientific breakthrough in the lab all the way to IPO readiness. It's a massive undertaking, and surviving it, well, it requires a very specific playbook for your capital and your risk.
Okay, let's dive into this. Here's our roadmap for today. We'll hit finding your fundamental fit, how deep tech actually compares to software, surviving the infamous valley of death, selecting the exact right capital, and finally, scaling to IPO readiness. Part 1. Finding your fundamental fit. Because before we even touch term sheets or capital allocation, we really have to talk about the human element driving the technology. There's this great analogy from Michael Hummel. He says, think about cooking. The founder is like the chef. The technology is like the ingredients. Ultimately, it's the chef that makes a great dish. And it's so true, right? In deep tech, investors are betting heavily on the jockey, not just the horse. You can have a literally world-changing technology, but if the technical founder lacks the specific skills to lead the business, well, the dish fails. A truly great founder knows their strengths, and honestly, they know exactly when it's time to bring in an experienced CEO to take the reins. So the crucial point here is shifting the power dynamic of fundraising. We've all heard of product market fit, sure, but in deep tech, what you really need is startup investor fit, or SIF. Fundraising is absolutely a two-way qualifying process. If an investor's fund life cycle or their specific risk appetite just doesn't match the reality of your development stage, the fit isn't there, period. No matter how big their checkbook is, you are looking for a strategic partner, not just a pile of cash. Mark Suster from Upfront Ventures really hit the nail on the head here. He says, we're looking for people who want to go on a 10 or 12-year journey with us. We're not looking for people to go on a 2-year journey. Deep tech requires just immense authenticity. Investors want to see that unfair advantage, that massive vision that proves you are the right person for a decade-long commitment. If you're looking for a quick 2-year flip, yeah, deep tech is definitely the wrong playground. All right, Section 2, Software versus Deep Tech. This is exactly why traditional VC advice, which is almost entirely built for software, totally fails deep tech founders. The contrast here is just night and day. A SaaS company, that's all about rapid iteration, getting that early user traction, and often scaling up within maybe 24 months, without heavy capital expenditure. But deep tech? It operates on a fundamentally different logic. We're talking heavy R&D, massive capital requirements, and a timeline of 48 months or more just to reach the point of scaling. I mean, you have to literally build a physical product and transition from lab to fab before you ever see a single dime of revenue. And this brilliantly illustrates the massive disconnect we see with traditional VC expectations. Think about the classic software timeline. Now compare that to the deep tech timeline. Deep tech lags behind for years, simply because of the sheer need to build physical capacity. Generalist investors, they get totally spooked here. But notice what happens around the 7-year mark. The revenues actually align. Once that first-of-its-kind solution finally hits the market, the value it provides to customers is deeply, deeply disruptive. Moving to Section 3, Surviving the Valley of Death. Because to get to that disruptive payoff, you've got to cross the grueling gap where science actually meets engineering. To survive this middle phase, you must train yourself to speak the investor's language. And in deep tech, that language is NASA's Technology Readiness Levels, or TRLs. Your goal over this 5 to 10-year journey is to systematically demonstrate asset buildup and constantly de-risk the venture. Years 1 and 2, that's your scientific breakthrough at TRL 1 and 2. Years 3 and 4, you're moving to a proof of concept at TRL 3 and 4. This is where things get real. It's not until years 5 through 7 that you actually hit Series 8 territory at TRL 5 and 6. And finally, years 8 to 10 plus, you're reaching market production at TRL 8 and 9. Now, what's really interesting here is how funding rounds map directly to this technological and commercial maturity. By the time you reach the Series A zone, investors expect the fundamental science risk to be completely resolved. Think about that. A Series A in deep tech isn't really about revenue. It's about proving that the science actually works and that your only remaining challenge is engineering execution. This means you have to hit very specific milestones at every stage. Above all, you absolutely must avoid what investors call double bets. That's a startup with high technology risk and an unproven market. You do not want to be a technology in search of a problem. So at the seed stage, validate your use cases with letters of intent from real customers. At Series A, show that the science is done and hyper-focus on your MVP and engineering. And by Series B, you need to be at TRL 7 or higher, showing a clear path to production in a market worth billions.
Section 4. Selecting the right capital. Because knowing your timeline is one thing, but how do you actually fund the whole shebang?
It brings us to a staggering reality check. How do you fund an average 9.2-year, $801 million journey to scale? Data from Bessemer's XB100 index shows that for the top deep tech companies, that's exactly what it takes. Now, your startup might require significantly less capital, sure, but the timeline, it's still going to be long. This demands a highly deliberate, highly optimized funding strategy.
You literally cannot just rely on standard VC equity here. You need to sequence your capital stack systematically. First up, non-dilutive grants. These are absolutely perfect for lab validation and early TRLs because they keep your equity intact to bridge that valley of death. Later on, corporate and strategic investors act as your first customers, giving you direct commercial value and pilot data. Then you've got venture debt, which is an incredible tool to extend your cash runway without diluting the founders. And finally, when you are truly ready for engineering execution at TRL 5 and beyond, you bring in the specialist VCs. Notice I said specialist. Generalists who don't understand your CapEx requirements are, frankly, just a distraction. I really want to highlight the massive potential of non-dilutive capital for a second. For instance, in the US, the recently reauthorized SBIR Phase 2 program offers up to $2.1 million. That is essentially free money to de-risk your technology in the earliest, most dangerous phases without giving up a single % of ownership. No way you should pass that up.
Let's move on and see how this builds into one overarching strategy. Delay dilution as long as humanly possible. Smart founders stack government funds like the US SBIR, the European EIC, or Germany's SPRIND. They use venture debt to bridge the gaps. By optimizing capital allocation this way, you systematically prove your hypotheses and preserve the massive upside for the initial risk takers, you and your early believers, long before you ever sit down to negotiate pure equity terms. Finally, Section 5. Scaling to IPO readiness. You've survived the valley, managed your capital. Now let's talk about the endgame. How do deep tech founders successfully exit after a decade of building? Well, the windows for M&A and IPOs absolutely are open, but only for fully de-risked companies. Based on research into clean and hard tech exits, the concrete recipe comes down to 4 steps. Number 1, ensure a favorable industry context. You need to be riding a macroeconomic wave. Number 2, achieve true commercial readiness at TRL 8 or 9. Number 3, gain high visibility to potential late-stage investors. And number 4, secure experienced management at the helm who actually know how to navigate the public markets or a major acquisition. As you plan this massive progression, you've got to remember the current structural shifts in the market. Right now, capital is heavily concentrating in proven winners. You must have tangible proof and pilot data to raise. Extended timelines are the new norm. Plan for a 24 to 30-month fundraising cycle just from seed to Series A. I mean, if you budget for a softer speed 18-month cycle, you are going to run out of runway for sure. But the good news? The European and US non-dilutive landscapes are expanding, and exits are definitely happening for founders who play this long game correctly. So, I want to leave you with this provocative question to think about. Does your current capital strategy truly match your technology's readiness level? I challenge you to audit your own startup investor fit today. Ensure your funding playbook aligns perfectly with your actual risk profile. Do that, and you will be incredibly well positioned to master the deep tech journey. You've got this.